It's 7:10. We're with Victor Sachs, our very own money man. Hello, Victor.
Hello, Scott. How are you?
I'm very well, thank you. How are you?
Very well, thank you.
Good to see you again.
And
Good to see you again.
And
now,
you.
we're going to be talking this evening about investments.
Yes.
We've done the sort of debt management side of things and
Yes.
and other bits and bobs. But now we're looking if you're in this fortunate position where you're sitting on a bit of cash. What do you do with it? That's a very simple question.
Oh, yeah, it's a very simple question, and you're quite right. There's people sitting there going, "Okay, yeah, this is what I want to know, what to do with it." And then you're going to come out at it from an advisor's perspective. It's, well, what do you want this money to do for you? You know, is it going to provide you with an income? Is it going to grow? And do you need it for a specific period of time, or can it be left alone for years and years and years and years? And this will help an advisor decide what's the best way forward.
I guess it depends what sort of stage in life you're at. If it's a saving for a nest egg, or for I don't know, if you're saving up for something specifically in the future, then it's more of a longer term investment. If you need an income from it, then it's a different type of decision altogether.
Correct, and this, you know, this is not what someone wants to hear. So right, I've got my money, I want to put it somewhere. How much am I going to get for it? And the last thing you want is someone to just put his hand up and say, "Just hang on a second. I have some questions that I need to ask you," but it's what we need to do, and it's becoming more commonplace, and we are starting to see clients who, for the last 10 years, have seen interest rates not too much.
Well, it's been 0.5% now for how long? 6 years? I can't remember, but yeah, it's been a long time. 6 to 8 years. It's been there. We've had high levels of inflation, so it's almost as if that the pound that's in a cash deposit account is almost earning as much as if you put it in a shoebox under your bed, which is something we've not seen in our generation. And this now then makes this client suddenly think, well, I've got to do something. And then perhaps, which we hope not, the adverts or something comes through the post or the email that kind of says, put your money here, 8% guaranteed for 3 years. And when you look at it, there's no Financial Conduct Authority marker on there. I've seen one where they're trying to use, where they're using a solicitor to deal with the transactions, that they're using the solicitor's regulatory authority as a means to show that the investment recommended is regulated. So what we're basically looking at when I'm looking at a client is almost, if you can picture a piece of paper on its side, a landscape piece of paper, and if you drew two lines, one going up and down, one sort of top to bottom, and then one going left to right, and the one going top to bottom is how much growth does someone want, and the one moving left to right is how much volatility, how much risk is someone prepared to take to get that growth. And generally we see that linear line going from bottom left to top right. So the further up we go, we take the assumption that there's more risk involved to get that bigger return. It doesn't always have to be the case, but the days of trying to get 15% annual return and have very little risk to money, it isn't out there. It really isn't in a simplest environment. But if someone wants to try and achieve a rate better than cash, then there's going to be some risk that has to be taken. But then currently there's risk, holding your money in a bank account where you're going to get 0.5% and the cost of living is at 1.5%. And that can be a very, very difficult conversation for a generation like us and a generation like our parents who were brought up knowing to save in a bank, in a builder society, in the post office to get those returns. And now that there's this whole seismic shift that actually someone's got to think outside of those areas in order to try and get some kind of return on their capital that they've worked so hard for. Well, let's start from the sort of low risk side of things. If someone's attitude to risk is fairly conservative, let's say, what options are best for them?
You have a number of environments. Collectively, you will hear someone talk about bonds, be they government bonds or be they corporate bonds. And whilst there can be, minutiae being taken out and pulled apart, essentially this is where, say, a government says we need X amount of £1 million or £1 billion to build something or do something, and while we're raising money, we're going to pay you a return.
Mm-hmm.
And when we talk about corporate bonds, it's a kind of similar thing, but instead of lending to governments, you're lending to corporates. But we'll deal with governments in turn. And do government bonds carry a risk? Yeah, because it depends on what's that democratic government all about. You know, well, what we think of the UK government is irrelevant to some point. They're democratically put there. It's recognised as a stable government, as is most of Europe, as is America, etc., etc., voted by the people. So these tend to have a lower risk threshold. And their returns they actually print pretty much fairly regularly in the big broadsheet newspapers. And they'll tell you that maybe they're going to mature in 4 years or 5 years. And while you're investing, we're going to pay you 3 or 4%. But when you see those kind of interest rate returns, you may have to pay more than the pound value, because each of these are issued with a face value, and the face value is generally a pound. But sometimes these are like, you know, this is the equivalent of the cup final ticket, or the ticket to Wimbledon, or the final day at Lord's on the Ashes. It may say one price on the ticket, but you're going to pay more. You know, so sometimes there can be a trade-off there in terms of, well, it says 5%, and that's based on a pound, but I'm having to pay £2. So now suddenly it's actually 2.5%.
Right.
Yeah. And when you're dealing with corporate bonds, it's the same, but now it's, well, who am I lending it to? Am I lending it to a big, well-recognised company? Or am I lending it to Joe's Tool and Pipe Works? Yeah. He might offer me more of a return, because actually there may be a more element of risk, as opposed to lending it to a big, recognised corporate body that we know that's reasonably safe place to invest our money. So bonds, be they government bonds or be they corporate bonds, would tend to offer a better rate of return than just sticking it in a bank or building society, and would be classed as, from our perspective, a low risk investment.
Okay, all right. So moving up the scale of risk, then, let's say, what about if someone's looking for a slightly higher return and they're prepared to swallow a little bit more of a risk?
Then you are into that market that we know of stocks and shares.
Yeah.
And rather than just going out and putting your money into one or two different companies.
Very risky. It's about putting all your eggs in one basket scenario.
Correct.
If you just invest in one or two companies and it goes south, you're in trouble. You're in danger of losing a lot of money.
Correct. So you will find that there are, you know, I mean, there's maybe 2,500 different investment funds for someone to look at. But again, I'm not going to go too far into it. We're just going to take a very high level view. We would expect a cautious to medium risk investment to carry some bonds that we've just mentioned about. If we looked at it, it might even hold some property, and it may even hold some currencies, and buy and sell those currencies as and when, you know, with a fund manager trying to work out when's the best time to buy and when's the best time to sell. But it will also contain stocks and shares within the most recognised indexes around Europe and the USA. So what you're looking at is a fund manager. You know, it's very difficult to draw a pie chart on the radio, but if you could draw a pie chart and have lots of segments within it, he will have some, you know, he or she will have some European stocks and shares from various European markets. Maybe not at this moment in time because of what's going on in Europe, but generally that's where that would be. There may be some cash just held in a bank. There'll be some government bonds. There'll be some corporate bonds. There'll be UK and there'll be US stock markets. And depending upon whether it's a cautious or a middle-of-the-road balanced investment, those proportions will change to reflect that. So if it's more cautious, there won't be so much exposure to the stock and share market.
Sort of volatility of
Correct.
stock markets around
Correct.
the world.
And what about fees? People often sort of a bit nervous about how much of their returns are being swallowed up by paying these expensive fund managers who sit in Canary Wharf or wherever they are, weaving their magic.
Well, and again, that's it. You've got,
I don't know how true it is, but I assume there are league tables of fund managers. It's a bit like some perform better than others.
Yes.
And there have been studies, haven't there? Correct me if I'm wrong, where if you just put your money in a normal tracker fund that tracks the FTSE, often they perform better than managed funds.
it can be, Scott, and certainly over the last this few years as a country, as a world comes out of that horrible place in 2008, we've seen pretty much markets generally everywhere go up, and it would have been difficult not to have achieved a reasonable level of return in whatever investment market as a stock market you put your money into. Times where we are now, where everything seems so great, yet everywhere else seems to be on its knees, is where you would want a fund manager to earn his or her corn. And yes, a FTSE tracker fund, which basically means that your money is riding that index and it's going up and down. And the minute a company comes out of that FTSE 100, the fund manager needs to sell those shares and buy the shares that's been replaced by this company that's come in. For now, and FTSE Financial Times share index, it's monitoring that top 100 companies, and various European countries will have various names for their stock markets and all these tracker funds around. But then you're just exposed to one country.
Right.
So if I'm dealing with someone who's first time in, who's never really experienced anything other than cash, but when you'll normally find someone sitting down and asking them 20 questions and coming up and saying, okay, based on those answers, you're in this box. We also have to, I believe firmly, I've got to use my experience of 21 years within the industry. It's not a lot, but it's longer than others and obviously shorter than someone else's. But with as well as asking those questions, you then look at the individual and you talk to that person. You've got to come to a decision that says, I know it says you are 5 out of 10, but this is your first time into getting involved with investments. I'm going to knock you down to a 3 and just gently ease you into this complete different world, and only then change things. And if you're looking at a 3, then you're looking 3 to 5, you're looking at someone to be blended, to not just be in one particular area any one time. So we smoothed out that jumping up and down, that heart rate monitor of fund performance. I don't want to see it going up, down, up, down, up, down, up, down. I just want to see it moving very gentle, almost like waves as they crash on the shore. Nothing stormy, just a nice ebb and flow, hopefully always going upwards, but helping that client understand how things work and go. And when that client is happy, then maybe we can change it and move them up a little bit.
Okay. All right. Thank you, Victor. I like that image about waves crashing on the shore.
Gently crashing.
Gently, yes.
Yeah, gently.
Right. So we're going to take a short break for some ads and a little bit of music, and we'll be back in a few minutes' time.
Huntingdon's answer to Michael Parkinson, Scott Phoebe, on Over to You.
That's 28 minutes past 7. Victor's just laughing at that jingle, but that was one of Bill's, so thanks for that, Bill. You are listening to Huntingdon's Answer to Michael Parkinson, Scott Phoebe. It's Victor Sachs here, the money man, our regular money man for our financial spot. We were talking about managed funds and so on, and you were coming on to the subject of fees and how they're calculated. I'm assuming it's a very complicated affair, but trying to sort of sum it up for us.
Yeah, of course. Listen, you've got an advisor. We've spoken about this. I think the first time I was on the radio. Out the company. You must have something about advisor fees, Scott. Don't know what it is. An advisor's going to turn around and say, I'm going to go and do all the research. I'm listening to you as an individual. I've got to do what we call this risk profiling questionnaire, where I ask X amount of questions, and there's a score out of 10, and the higher, lower, middle, wherever you are, then yes, I need to do that. But then I'm also going to have a conversation with a human being, use my experience, and then say, this is where I think we should go away, do my research, come back and present, and there will be a cost and a charge for that. What it will be, it's not fair for me to turn around and say what it is, because everyone charges differently. But if I'm going to stick a figure somewhere, you should be paying around 3% would be an expected amount for as a one-off.
So 3% of the amount invested.
Of the amount that we're talking about that you want an advisor to deal with. All right. Now, in terms of what's XYZ investment company going to charge, it's going to be the fund manager.
Is that do they? Is it a flat charge, irrespective of the performance of the fund, or do they take a little bit more if the fund does better? How does it tend to work?
No, they'll as far as they're concerned, the more they can get under management and the bigger they can grow, because it will be a percentage.
I see.
On that pot. So we would expect to see, and again, and there is a huge variance. It does depend on the complexity of that fund that you're looking at. You can be looking at a charge of maybe 0.4%. So for every £1,000 that someone's invested, this fund manager is going to charge £4 over the year.
I see.
To manage. I've seen it as high as 2.5%. But this may involve buying and selling various. When they talk about commodities, this could be, when they talk about hard commodities, which could be your gold and your precious metals, so the drilling stuff, and it could be soft commodities, in other words, the stuff that grows above the ground, the vegetables and the wheat, etc., etc. So depending on what is being bought and being sold and how often, the fund manager may be doing a lot of work. He may also be buying across continents. He may have to be up 15, 16, 17 hours a day to watch the markets trade. Yeah. So he's going to want to charge a little bit more. And I agree with you, Scott, that I would expect to see that in the performance when compared to his classroom, or we call it the peer group. I prefer to call it as the classroom. Here's my pupils in the class. Show me what the average pupil is achieving over his period of time, and where is this particular pupil.
And this is all this information's all available in the financial press. I assume the FT or whatever, they've got all the performance of the funds.
You got it, absolutely. Or let a good financial advisor take the strain off that individual. Yeah. The biggest thing, and we were speaking about this off air, the biggest thing now is we've got individuals work damn hard for their money. Have always used the cash account, the deposit account, the bank and the building society and the post office. And now that rock has changed and it's moved. In terms of, protecting someone's money from inflation and from general cost of living, and to ensure that £10,000 or £1,000 or £50 or £1 that you had 10 years ago can still buy what £1 bought today. You couldn't have stuck it in a bank account, because it would have just been ravaged by an inflation that went out to 2-3%, and interest rates stayed at 0.5%. So everything's going up by 3%, and your money's only going up by half. Yeah. So it's a seismic shift to suddenly accept that I've got to do something different with some. No one would recommend that everyone does something with everything. We still need that money for rainy day, but there's an amount, perhaps, I don't know, that someone will sit there and go, this is more than I need on a regular basis. I need to do something with it. And be whatever that is, and the amount is irrelevant. It's recognising that this is the most precious thing that a person can ever do. Build up a cash lump of money that they can see, touch and feel. We can all stand outside our house and look at our house and go, there it is, I haven't got a mortgage anymore. But you go and try and take 50 quid out of that house. You can't just take a brick and go, there we go. Yeah. You've got to go through a lot of paperwork to get some money out of a house. Whereas cash in a bank, in a building society,
it's liquid.
It's liquid, and it's there, and you know how hard you've worked for it. Yeah. And I see that with a lot of clients. It's precious to them, and it's, well, what can I do with this?
What about someone then who wants, you talked about the sort of motivations behind saving, someone who needs a bit of an income. Let's say you've got someone towards retirement, or coming towards the end of their working life and going into retirement. They have an asset, their house, that's presumably the mortgage is paid off, they own, but they've got very little income. How do they generate income from any savings that they have?
There are specially designed investment products that literally use the income. Excuse me, what is called dividends. Now, anyone that's ever held a share, and if we look back this year, we saw probably one of the biggest dividend payouts in history, which was from Vodafone for their disposal of an American telephone company called Verizon. A dividend, so a company basically sits at the end of each year, says, have we made a profit? Yeah, we have. How much have we made? Wow, we've made a lot. Let's have a dividend payout to all of our shareholders. And anyone out there who runs their own limited company would have been advised by a good accountant like yourself, Scott, to say, pay yourself a salary, and then at the end of the year, if we know you're going to make a profit, you can take a dividend. It's good for tax, and it's an efficient way of extracting money out of a company. Multiply that by tens of thousands of people, and you've got the big conglomerates out there today. They are looking at how much money have we made? What do we need for next year? What do we need to invest? We've got some money left over. Let's make a distribution. Let's make a dividend. And if we look at probably even the top 100 companies in this country, ignoring the fact that their price per share will go up and will go down, and almost the left column, if you like, say, well, okay, what's that money? If we looked at the right column, monies received in terms of dividends, it will be very high in comparison to what's going on in cash. To get 5, 6, 7, 8, 9, sometimes double digit from these big companies on an annual basis is not an impossibility. None of us can sit here and say it's guaranteed. But if someone is looking for a cautious route to market to provide an income, you know, you could do, you could, there's no reason why you wouldn't consider. Then we go back to that questionnaire and having that chat with that individual. Is this the first time you've ever done this? To achieve income and a good level and sustainable income, it's not an impossibility, and someone doesn't have to jump on the roller coaster of investment to get that kind of return.
I think an important lesson, I think, for a lot of people is that any investment, you know, you've got to think sort of medium to long term, aren't you? You're not talking about making a lot of money very quickly. That's not the idea behind it. I think sometimes people, you know, as you say, investments go up and down, markets go up and down, and so on. Even house prices and property prices go up and down, as we've discovered over the last 20 or 30 years.
Yes.
I guess the idea is not to panic, if you like, if the fund performance doesn't meet what your expectations were, because it's a long-term thing.
Absolutely. I mean, I'm saying absolutely. At the end of the day, the majority of investment opportunities out there, and let's first of all look at, you know, worst-case scenarios. The Financial Services Compensation Scheme covers these types of investments up to the value of 90%. With no upper limit. Then almost actually it's offering a better protection than that you would get if it was in a bank account.
Well, the bank's limited, is it 70,000?
It's 85.
85, yeah. It used to be 30, I think.
Correct.
And then 2008.
Correct.
With all the problems with Northern Rock and RBS.
Correct. And that's going to cover, you know, a hell of a lot of people and a good majority of the population. But if someone wants more protection than what the banks can offer, then a lot of investment funds are covered up to 90%.
Is that right? I didn't know that. So you invest, and that's unlimited. That's not capped.
Correct.
So you
provided it says so on the tin, as a, you know, so
that's something to look out for. So the worst case scenario, if I invest 100,000, let's say, worst case scenario is that I've got 90,000 guaranteed.
Well, only in the event of the collapse.
I see. Yeah. Okay.
This is not, you know, if it turns out to be not the flavour of the month, and you're not talking to your advisor and your advisor's not talking to you, and all that's happening is this investment is dive bombing down, there is nothing you can do.
I see.
When you're talking about, you know, time spans, how long you invest for, very few investments these days, unless it actually says it, there's no time limit. If I can't stop any client coming out a month after they've gone in, if that's what they want to do. My recommendation, and it's only a recommendation, is that monies are held for 5 years.
Yeah.
But emergency strikes, or if a client says, you know what, I've seen it go up or I've seen it go down, I'm not happy, I'm not comfortable, I want to come out, there's going to be no penalties applied. The market's moved for or against them, but all we can do is recommend, and to allow for funds to increase and decrease, economic cycles to take place. Yeah, we would recommend a 5-year cycle be given. And ideally not to sit there and look at it every day, because you end up with hair like mine. And if no one knows what I look like, I'm shorn of hair. Or if I hadn't any, it'd probably be grey. The thing to do is arrange with, if you're going to go through an advisor, and obviously not because that's what I do, but I would recommend one. They are qualified, whatever we think.
And independent, I guess, is important as well, because you have access to the whole market. I suppose that's the advantage of dealing with an IFA.
You do, but I'm not one of these guys that's going to sit there and go, oh yes, again, yeah, I'm an independent advisor. But if it's something, at the end of the day, for someone who's going to take their first steps out of cash, it doesn't really matter in the nicest possible way. Because it's going to be more education for that individual's ever received. Maybe once they get to know what's going on and they get excited by these things and they want to know more and do more and get right out to, some of these unregulated investments. There's nothing wrong with them as long as someone knows what they're getting involved with.
Well, let's talk about that. We're going up to the risk scale, aren't we? So
before we get there, then in terms of risk scale, we've dealt with sort of cautious and medium term. When we start talking medium adventurous, we're going to start seeing an introduction to the uncertain demographics, the uncertain parts of the world. We're looking at Brazil, you're looking at Russia, Nigeria, South Africa, you're looking at China, India, Pakistan, Korea. Russia. We're out of, kind of normal arenas, and now we're dealing with something that's a little bit different. We're also possibly introducing, as we were saying about commodities. Yeah, and they do talk them in hard and soft. Hard as in I've got to use some serious drilling stuff to get it out, and the soft being, well, all I've got to do is plant. Yeah, and then that way, hopefully, listeners can suddenly realise, okay, I know what we mean by hard and a soft commodity. These things are very, certainly soft commodities, very seasonal, very bad weathers, and everything else can really affect it. And when we look at these risk areas, Brazil, Russia, South Africa, China, Nigeria, any parts of Africa, you're going to start, there's areas that we're really uncertainty of, and in terms of democratic, politically approved people and a proper democratic voting system and everything else, and zero corruption within any governments, there's stuff there we don't understand. But
the returns are potentially greater.
Last 12 months, you look at an Indian equity fund, it on average has returned 50 to 70% in the last 12 months.
And this is just economic growth, I suppose. I mean, the was it announced the other day, I think they're expecting growth in the UK of between 2.5% and 3%.
Correct.
This year, which is the highest in the EU, certainly.
Yes.
So it's not a huge return, but potentially safer.
Correct.
But if you get someone who's a little bit more chancy, let's say, and a little bit more,
or if you're going to get a country or an area that's going to come from a lower starting point and a lower standpoint, then obviously if someone's going to put in some economic reform, make it work, make it the place to go for stuff, you're going to start seeing these 50, 60, 70% returns.
But you said that these are unregulated.
No, they're not necessarily unregulated at all. There will be some very big banks and financial institutions that have got their own investments and their own investment fund managers managing those areas. By the sheer nature of the countries that are used, they would come attached with, this is a moderate to adventurous or an adventurous investment strategy.
Yeah.
And therefore you accept that there's going to be some highs and there's going to be some lows.
Yeah. Okay. Fantastic. Thank you for that, Victor. We're going to have to take another short break for some ads, and we'll be back in a couple of minutes' time. You're listening to Scott Phoebe on Over to You, HCR104FM, just coming up to 10 to 8. We with Victor. Just finishing up, Victor, we were talking about unregulated investment. What does that cover?
We've mentioned, we'll go back the other way. We mentioned the Financial Services Compensation Scheme and what it can cover. I think there's enough of a spectrum for someone who's very, very, very cautious to the quite adventurous to get involved in all that they want to get involved with within a regulated environment. We're seeing them, the storage, come and buy shares in the storage box company, come and buy some Her Majesty's Land Registry land and have some shares in this and with that. And when you look deeper into it, there is no regulation applied to it. So you lay yourself to it going up and going down, and if the company goes out of business, then your money goes with it too. I'm not going to sit here and say it's wrong. There are some people who like those types of things. I'm just saying there's enough things that are regulated. But if you are looking at an unregulated, just recognise what you're getting involved with. You know, if you're going to go and play the roulette wheel, know what you could possibly come out with. And that's all I would ever say on it. I won't rule anything in or anything out. I'll talk to a client about them. If I feel that they are more at 9 and 10 out of 10 on that risk scale, but I would not recommend them to someone who is just going to venture out of cash for the very first time. Yeah. The strategies that we put in place and I put in place that we've spoken about today, it's whether it's an ISA that we're going to use for short-term savings or whether it's a pension for long-term savings, whether this is someone who has money in their limited company or this is someone who's saved for years and years and years. The strategies and how we work out where the client should invest are exactly the same. The first and foremost is, let's work out what you want to achieve with your money. If anyone wants to, you can email the studio. They can contact me. My telephone number 01733 232249, and they can go to. I even got my own website, which is www.business-ifa.co.uk, or the company one, which is rgl-ifa.co.uk.
Fantastic. Thank you very much for that, Victor. It's always a pleasure to speak to you.
Thank you very much.
I'll just give those contact details again in case you were scrambling around for a pen. The telephone number if you want to get in touch with Victor for any advice on any of the topics that we've discussed tonight or anything else related to financial services, then Victor's number is 01733 232249 or the website www.rgl-ifa.co.uk. Great. Thanks very much for your time, Victor. And we'll see you fourth Monday of, where are we? November.
Yeah, thanks for that. Yeah, okay. The fourth, not the third one.
Not the third.
Yeah, thanks.
See you next month.